Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.16 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover what algorithmic correlation is, why it matters for every trader, a simple real-world example of two algorithms that trade the same market, how to visualize that correlation on a price chart, the common beginner mistake of ignoring overlap, the painful loss that can happen when you do, a step-by-step process for measuring correlation, how to use a correlation matrix in everyday trading, adjusting your position sizes based on those insights, and finally how to weave correlation awareness into your overall risk management plan. By the end of this video, you will understand how to spot when two or more of your automated strategies are moving together, how that can unintentionally double up risk, and you will walk away with a clear, beginner-friendly method to measure, interpret, and act on that information. Think of it like two friends pulling on the same rope. If they both pull forward, you get extra force. But if one steps back, you lose strength. In trading, those forces are your profit and loss. This lesson will give you the tools to see that rope, measure the pull, and decide whether to keep both friends or ask one to step aside. Let's get into it. Let's start by defining algo correlation in the simplest possible way. Correlation is just a word that tells us how much two things move together. In the world of algorithmic trading, an algo is a computer program that decides when to buy or sell based on a set of rules. When we talk about algorithmic correlation, we are asking the question, do two different programs tend to place trades at the same time, in the same direction, or are they acting independently? Imagine you have two friends who love to suggest movies. If they both always recommend the same genre on the same night, their tastes are highly correlated. If one likes action and the other prefers documentaries, their tastes are uncorrelated. The same idea applies to trading bots. If Algo A, a trend-following bot, and Algo B, a mean reversion bot, both start buying euro to US dollar whenever the price crosses a certain level, their trades will line up, creating a high positive correlation. The significance lies in risk. When two bots are doing the same thing, the profit or loss from one is duplicated by the other, effectively doubling the exposure without you realizing it. Conversely, if the bots are negatively correlated, one buying while the other sells, they can offset each other and smooth out volatility. Understanding this relationship helps you avoid unintentionally stacking bets on the same market move, which is a common way beginners bleed money. In the next scene, we'll explore why keeping an eye on that hidden overlap is a non-negotiable habit for any smart trader. Now that we know what algorithmic correlation is, let's talk about why you must monitor it every day. Think of each algorithm as a separate worker in a warehouse, each moving boxes of inventory. If two workers pick up the same box at the same time, the box gets moved twice as fast, but also twice as likely to be dropped. In trading, that box is your capital. When two bots are highly correlated, they're essentially placing the same bet twice, which means your effective position size is larger than you think. This hidden leverage can turn a modest profit into a big win, but can also turn a small loss into a devastating blow. A common beginner mistake is to look at each algorithm's performance in isolation, assuming the risk is limited to the individual settings. In reality, the combined effect can push your account close to margin limits without any warning. For example, imagine Algo A has a $1,000 long position on pound sterling to Japanese yen, and Algo B, unaware of, also opens a $1,200 long position on the same pair at the same time. On paper, you see two separate trades, but your true exposure is $2,200. If the market moves against you by 1%, instead of losing $0.12, you lose $22, a much larger hit to your account equity. By continuously monitoring correlation, you can spot these overlaps early, trim or offset one of the positions, and keep your overall risk within the limits you set. In short, ignoring correlation is like walking a tightrope with a blindfold. One misstep can send you crashing. The next steps will show you how to measure that correlation and act on it before the market gives you a surprise. All right, looters, let's bring two simple trading robots to life with a real-world example. Imagine you have a momentum algo that watches the euro-dollar pair, euro to US dollar. Its rule is straightforward. If the price climbs 10 pips in half an hour, the algo jumps in and buys, hoping the rise continues. If the price drops 10 pips, it sells. Think of it like a friend who always jumps on a roller coaster when it's going up fast. Now picture a second robot, a mean reversion algo, focused on the pound-dollar pair, pound sterling to US dollar. This one likes to buy when the price suddenly falls 8 pips, assuming it will bounce back, and sell when it spikes up, expecting a pullback. It's like a shopper who always buys a dress when the store puts it on sale, betting the price will rise again soon. Both algorithms run automatically 24 hours a day, making tiny decisions based on tiny price moves. Even though they trade different currency pairs, they can still affect each other because the euro and the pound often move together in response to the same news, like a European central bank announcement. When the ECB raises rates, both euro to US dollar and pound sterling to US dollar might jump at the same time, causing both algos to open positions simultaneously. This shared reaction is the seed of correlation, the degree to which the two robots' outcomes move together. Understanding this example helps us see why we need to watch not just what each algo does, but also how the markets they trade are linked. By the end of this scene, you should be able to picture two simple bots, each with a clear rule, and recognize that even different pairs can dance to the same music. Now that we have our two robots, let's see how we can actually measure whether they are moving together. The tool we use is called a correlation coefficient, which is just a fancy number between -1 and +1 that tells us how closely two things follow each other. A value close to +1 means they rise and fall almost in lockstep. 0 means they have no relationship, and -1 means they move in opposite directions. To visualize this, picture a chart where the green line shows the daily profit or loss of the momentum algo, and the red line shows the daily profit or loss of the mean reversion algo. When both lines go up on the same day, the green and red lines rise together, creating a pattern that looks like parallel hills. When both drop, the hills dip together. If you look at the top right corner of the chart, you'll see a small white box that reads CORR equals 0.78. That number tells us there's a strong positive correlation, meaning the two algos tend to earn or lose money at the same time. Below the line chart, we add a scatter plot. Each dot represents one day's pair of returns, with the horizontal axis for the momentum algo and the vertical axis for the mean reversion algo. If the dots cluster along an upward sloping line, that visual cue confirms the positive correlation. The tighter the cluster, the stronger the relationship. By looking at both the line chart and the scatter plot, you can instantly see whether the two bots are dancing together or stepping on each other's toes. This visual approach makes the abstract idea of correlation concrete, so you can start asking the right questions about risk and diversification in your own algorithmic toolbox. Let's talk about a common pitfall that many beginners fall into, ignoring the overlap or double exposure between their algorithms. Imagine you have a trading account with $10,000 and you decide to run both the momentum algo on euro to US dollar and the mean reversion algo on pound sterling to US dollar, thinking they're independent because they trade different pairs. You set each to risk 2% of your account per trade, which sounds safe. Now picture a surprise news event, like a sudden political announcement in Europe, that pushes both the euro and the pound down at the same time. Because both algorithms are designed to sell when prices fall, each opens a short position on the same day. In the chart, you'll see two red loss bars stacked on the same date, showing that both algos lost money simultaneously. Since you didn't realize they were correlated, the combined loss is not just 2%, but roughly 4% of your account because the losses add up. The green equity line on the chart drops sharply, illustrating how your account value shrinks faster than you expected. This mistake is called ignoring overlap. You assumed the trades were separate, but in reality, they overlapped and doubled your risk. The consequence is a larger drawdown, which can be painful for a beginner who is still building confidence. The key takeaway is to always check whether your algorithms are likely to fire at the same time. If they are, you need to reduce the size of each trade or add a buffer so that the total risk stays within your comfort zone. By recognizing overlap early, you protect your capital and keep your trading journey on a smoother path. Now let's see what happens when we ignore the overlap between two algorithms. Imagine you have two simple bots, Algo A and Algo B, each designed to trade the same currency pair, Euro over USD. Algo A is a buy-the-dip bot. It opens a long position when the price drops to a certain level, say 1.1000. Algo B, on the other hand, is a sell-on rally bot. It opens a short position when the price climbs a little higher, perhaps 1.1010. On a quiet day, both bots fire their orders, thinking they are acting independently. In our chart, you can see the green arrow for Algo A's long entry at 1.1000 and the red arrow for Algo B's short entry at 1.1010. Because the market only moves a few pips, both positions stay open together. When the price then slides down to 1.0990, Algo A finally makes a small profit, but Algo B, which was betting the price would rise, now incurs a loss of 10 pips. Since you still hold both positions, the loss from Algo B wipes out the gain from Algo A and adds extra damage because you are effectively double exposed to the same move. In total, you lose 20 pips instead of just 10. This example shows the danger of ignoring algorithmic correlation. The overlap creates a hidden risk that magnifies losses. The takeaway is simple. Always check whether your bots are stepping on each other's toes before you let them trade together. By spotting overlap early, you can avoid turning a modest loss into a costly mistake. Measuring the relationship between two algorithms may sound technical, but we can break it down into 5 easy steps, just like following a recipe. Step 1. Export the trade data. Most platforms let you download a CSV file that lists every trade: the time it opened, the price, the direction, buy or sell, and the profit or loss. Think of this as gathering all the ingredients you need for a cake. Step 2. Align the timestamps. Your two bots may not trade at exactly the same moments, so you create a common time grid, for example, 1-minute intervals, and fill in each bot's profit or loss for that minute. If a bot didn't trade that minute, you record a 0. This is like arranging your ingredients in the same bowl, so they mix evenly. Step 3. Calculate the Pearson correlation coefficient. This statistical formula compares the two sets of numbers and gives a value between -1 and 1. A result close to 1 means the bots move together, close to -1 means they move opposite, and around 0 means they are unrelated. You can do this in a spreadsheet by using the equals Correl range 1, range 2 function. Step 4. Interpret the number. If you get 0.78, that tells you the bots have a strong positive relationship. They tend to win and lose at the same time. If the number is -0.45, they often offset each other, which could be useful for hedging. Step 5. Document the result. Write down the coefficient, the date range, and any market conditions that might have influenced it, such as a major news event. By following these steps, you turn a vague idea of "they seem similar" into a concrete number you can act on. This process works for any pair of algorithms, any currency pair, and any time frame, giving you a reliable tool to manage risk. Now that you have a correlation matrix, let's see how it guides the size of each position you hold. Imagine you run 3 simple bots. Algo A trades pound sterling to US dollar, Algo B trades euro to pound sterling, and Algo C trades US dollar to Japanese yen. After measuring correlation, you fill out a matrix that looks like a spreadsheet of friendship scores. The diagonal cells are always 1.00 because each bot is perfectly correlated with itself. Off-diagonal cells show how much they move together. In our example, Algo A and Algo B have a coefficient of 0.85. That's a strong positive link, meaning when one makes money, the other likely does too, and when one loses, the other loses as well. Algo A and Algo C, however, only have 0.20, indicating they are mostly independent. To protect your overall portfolio, you want less exposure to bots that are tightly linked. A common rule of thumb for beginners is to cap the combined exposure of highly correlated bots at 50% of your total capital. So, if you plan to allocate $100,000, you might assign 40% to Algo A, but only 20% to Algo B because its high correlation with A means you're effectively double betting the same market move. Algo C, with low correlation, can keep a larger share, say 40%, because it adds true diversification. Visually, you can see a bar chart where the bar for Algo B shrinks after you notice the 0.85 coefficient. This adjustment reduces the chance that a single market swing wipes out two of your bots at once. The key takeaway: use the matrix as a traffic light. Red numbers, close to 1 or -1, signal you should trim position size. Green numbers, close to 0, let you keep or even increase exposure. By integrating correlation into your risk management, you build a more balanced and resilient trading system. All right, looters, now that we can see when two of our algorithms move together, it's time to act on that information. Adjusting positions means changing how much money we put behind each trade based on the strength of their relationship. Imagine you have two friends who always order the same meal at a restaurant. If you only have one plate of food, you wouldn't give both friends the full portion because you'd end up with a huge waste. In trading, the same idea applies. Let's say Algo A and Algo B both trade the euro to US dollar pair. Yesterday, they each opened a 1.0 lot long position, and the correlation calculator showed a 0.92 coefficient. That's a very high positive link, meaning they almost always move in the same direction. If the market drops, both lots could lose money at the same time, doubling your risk. To protect ourselves, we can reduce the size of one of the trades. For example, we keep Algo A at 1.0 lot because it's our primary strategy, but we cut Algo B down to 0.5 lots. This halves the exposure from the second algorithm while still keeping its edge. Another option is to stagger the entry times or add a small opposite trade. But the simplest beginner step is to lower the position size. By doing this, even if the market moves against us, the total loss is less severe because the two trades no longer add up to a full 2.0 lots of risk. Remember, the goal isn't to stop trading. It's to balance the amount of money at risk when algorithms are tightly linked. Adjusting positions based on correlation insight keeps your portfolio safer and gives you room to add more diverse strategies later. Welcome back, looters. After we learn how to resize individual trades, the next logical step is to weave correlation awareness into our overall risk management plan. Risk management is simply the set of rules we follow to protect our trading capital from big, unexpected losses. Think of it like a household budget. You don't spend all your money on groceries and then have none left for rent or emergencies. In trading, we allocate a certain percentage of our total account to each strategy, and we also set a maximum amount we are willing to lose in a day or a week. Correlation helps us see where hidden overlaps exist. Suppose you run 3 algorithms. Algo A trades pound sterling to US dollar, Algo B trades euro to pound sterling, and Algo C trades euro to US dollar. When you run a correlation matrix, you discover that Algo A and Algo C have a coefficient of 0.85. They often move together because both involve the euro. If you allocate 30% of your account to each algo without considering this link, you could unintentionally expose 60% of your capital to the same market move. To integrate correlation, you first calculate the combined exposure. Multiply each position size by its correlation factor, then sum them. If the total exceeds your predefined risk limit, you reduce the size of the most correlated algo or add a less related one, such as a commodity algorithm. This way, the overall portfolio risk stays within your comfort zone. Additionally, you can set a rule like no two algorithms with correlation above 0.7 may together exceed 40% of the account. By embedding these correlation checks into your daily trade checklist, you ensure that the sum of all hidden risks never blows past your safety net. In short, correlation becomes a safety valve that keeps your portfolio balanced, just like diversifying investments in a retirement fund. Let's wrap up what we covered today, looters, so you can walk away with a clear checklist. First, we defined algo correlation as the statistical relationship that tells us how similarly two automated strategies move. A high positive number, close to 1, means they tend to rise and fall together, while a low or negative number indicates they act independently. Second, we explained why monitoring this relationship matters. Without it, You might think you have diversified trades, but in reality, you could be stacking the same risk on top of itself. Third, we walked through a real-world example with Algo A and Algo B on Euro to US dollar, showing a 0.92 correlation and how we reduced Algo B's lot size from 1/2 a lot to lower combined exposure. Fourth, we demonstrated how to visualize correlation on a chart using a matrix, making it easy to spot overlapping strategies at a glance. Fifth, we warned against the beginner mistake of ignoring overlap, which could turn a modest loss into a double-dip loss, as illustrated by our loss example. Sixth, we gave a step-by-step process for measuring correlation. Collect price data, calculate the coefficient, plot it, and interpret the result. Seventh, we introduced the correlation matrix as a practical tool for quick reference. Eighth, we showed how to adjust positions based on those insights, either by scaling down, staggering entries, or adding unrelated algorithms. Ninth, we integrated correlation into a broader risk management framework, setting limits on combined exposure and using rules like no two highly correlated algos exceed 40% of capital. Finally, we emphasize that consistent monitoring and disciplined adjustments keep your trading portfolio resilient, just like a well-balanced team where each player brings a unique skill. Keep this checklist handy, apply it to your own algorithms, and you'll turn correlation from a hidden danger into a powerful ally. That is everything for Lesson 11.16, Correlation between Multiple Algos. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? Your feedback not only helps us improve, it also builds a community of fellow looters who are all learning together. In the next lesson, we'll dive into algo execution speed, where we'll explore how the time it takes for an algorithm to place an order can affect slippage, fill rates, and overall profitability. You'll see real-world examples of fast versus slow execution, learn simple ways to measure latency, and discover practical steps to tighten your own algo's timing. Remember, mastering each piece of the puzzle, correlation, execution, risk, creates a stronger, more resilient trading system. Keep experimenting, keep reviewing your data, and don't be discouraged if the concepts feel heavy at first. Every expert started exactly where you are right now. That's the beauty of algorithmic trading. It's a skill you can build step by step. So, thank you for sticking with us through this deep dive into algo correlation. As always, keep turning those ticks into treasure. Keep turning those ticks into treasure.